Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledn, and as with every Tuesday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Tuesday, December 7th, and we have a very special episode for you this week as always. In today's issue, we're going to start by covering the recent volatility that's taken a hold of the markets recently, and we're going to discuss why the upcoming holiday season could be a volatile one as well. Second, we're going to talk about the Ethereum micro futures, which started trading in the CME this morning, or yesterday actually, and we're going to look at what we can expect from that part of the industry as well, given the recent development. And last but certainly not least, we're going to look at the projections for November inflation in the US. All signs point that it will be a scorching hot report this week. We're going to talk about how that could impact markets. So grab your coffees, everyone. It's going to be a great one. Starting as we usually do with Bitcoin, we see that it was a volatile week last week for Bitcoin, with prices dropping nearly $10,000 in just 1 hour in the early hours of Saturday last week. Prices did recover from Saturday's lows of nearly 41,000 to close Sunday evening at $49,463, closing down 13.73% for the week. We have seen that there has been, it seems to be holding ground so far this week, and we'll get into some of the price action or some of the movements that we're seeing on some of the derivatives part of the Bitcoin side very shortly. The headline that we're going to share, the headline on your screen right now, just highlights that drop, that big drop that we saw over the weekend. As we mentioned, and again, it makes reference to the fact that Nayib Bukele, El Salvador's president, actually tweeted right around that time saying that he and El Salvador had bought the dip. Outside of in addition to this, the move did impact some of the derivatives open interest and positioning. One part of that was a big impact was in the open interest in the Bitcoin futures markets, where about $10 billion essentially were wiped based on the recent move. So if we see here, right at this peak here, the total open interest was around $26 billion. And we see that right after the move, the total is sitting at around $16 billion. So we see that around $10 billion worth of open interest from the Bitcoin futures markets were basically cleared. And again, these open interests in the futures markets are typically used by investors to access leverage. So it makes sense when we have big sudden sell moves like this, that a lot of this open interest gets essentially flushed out. This type of deleveraging is often seen as a healthy sign for markets, although it is also important to note that the open interest for futures, even at 16 billion, remains relatively high. Again, just relative to historicals, even at 16 billion, that's still quite a bit of open interest relative to Bitcoin's historical open interest in the futures. A lot of this surge or new surge in open interest contracts for futures comes from the fact that there's a Bitcoin ETFs now, and these Bitcoin futures ETFs must hold a lot of futures contracts. So some of it can be organic. It's just hard to tell how much of the wash down essentially was a lot of leverage, and how much of it is this organic demand. It seems to be finding a balance at the current levels. In addition to what we're seeing in the futures, we've seen, let's just take a look here at the perpetual swap funding rates for Bitcoin, and we can do Deribit and FTX. And what we can see here is that prices, although prices have somewhat stabilized since the big drop over the weekend, funding rates and perpetual swap funding rates for that time, we can see went deep into the negative, both FTX and Deribit. We see that they've actually since normalized, and they are seeing, right now they're sitting in the positive. Actually, it's a bit mixed, with FTX in the negative and Deribit in the positive. So again, the market seems to be finding some type of equilibrium at the current levels. We don't know how long that will stick around for. So again, the fact that the perpetual swap funding rates are basically hovering around zero, it tends to be a healthy sign to start the week. outside of price action in Bitcoin, we saw that US regulators also provided additional color around Bitcoin ETFs with some of their remarks. The headline that you have on your screen right now basically talks about Gary Gensler's comments last week. And noticeably here, Gensler, who's the chairman of the SEC, reiterated his concern with spot Bitcoin ETFs, noting that although some of these spot Bitcoin ETFs had been approved by other regulators outside of the US, this should not influence the US decision on whether to approve a spot Bitcoin ETF or not. Obviously, the news, as we saw here, the biggest expectation in the market right now is that GBTC will or can eventually turn into an ETF, a spot ETF. And we see here that the discount between the net asset value of the units and the Bitcoin that it holds actually went to it went to the closest it's been to parity since September of this year at single digits. Basically, the difference was just 7.92%, so about an 8% discount between the units of the fund and the underlying Bitcoin that it holds. However, we see that after Gensler's comments last week, that discount basically moved very rapidly into the double digits again, and it's currently sitting at 15.51%. So again, the market's interpreting Gensler's comments as a sign that we won't be seeing a spot ETF approval for the GBTC in December 24th as it is scheduled. So these sold off to reflect the market's views. Another interesting development on the sort of pipes here around the futures is the fact that institutions, if we look here at a segmented breakdown of the investors that are holding the Bitcoin futures on the Chicago Mercantile Exchange, what we see is actually quite interesting. Just trying to find here it is, the open interest chart for CME futures. And here it is. What you see here is essentially the different types of participant in the CME Bitcoin futures markets. And what we see here that is very interesting is that institutions have basically gone from being, the second smallest holder of funds by July, the second smallest sort of holder in terms of the different segments, to becoming the absolute largest holder of Bitcoin futures right now. So institutional investors are now essentially the largest holders of Bitcoin futures contracts that currently are open in the Chicago Mercantile Exchange. Interestingly, these are the same contracts that are held by the Bitcoin futures ETFs. And interestingly, again, institutions seem to have increased their long exposure on Bitcoin even as the recent price action has dropped in Bitcoin. So that's interesting. A few closing thoughts on price action as we head into the holiday season. Even though last week's move was very large, the spot volume, and I want to just highlight this as we talk about this, the spot volume of last week's move, which is this little red bar down here, was less than half of the volume that we saw traded on May 19th. So again, this is the week of May 19th when we had another big considerable drop. We see here that in fact the volume that was traded on last week's move was quite low relative to the volume that gets traded when we see other similar moves down. As we move closer to the holiday season, the depth in the order books will dwindle. And this happens because traders move away from their desks to spend time with family, and that's natural over the holiday season. What this does, though, is that this tends to have an amplifying effect on any directional move because the order books are very thin. Any large order that goes in either direction tends to move price a lot more than when the book is very thick. And so what this does is that it adds more volatility. And that is why we could be heading into a somewhat volatile holiday season. So keep that in mind. Checking in with our analysis of the S&P 500. This is the weekly chart, but I just want to show a daily chart to highlight just how volatile the last few trading sessions have been for the S&P 500. As we see here, every one of these bars represents a 1% plus move. This bar is a 2.767% move. This is 1.65, 1.52, 1.7, 1.71, 1.2, 1.4. Today is up 2.04%. So all I'm trying to say here, all we're trying to say here is that the S&P does not typically move by more than 1% in 7 or 8 consecutive trading sessions. That is a lot of volatility for a market that is very large. Going back to the weekly, we saw that last week the index looked poised to recover from the previous week's losses, but things took a turn for the worse when Jerome Powell announced that the Federal Reserve may have to accelerate its bond tapering purchasing plans last Tuesday. So this caused this, the S&P was trading higher somewhere around Tuesday. On Tuesday, the news broke and the market just sold off quite significantly. What we're seeing today is that there seems to be almost a full reversal of the drops that we saw in the previous 2 weeks. But back to Powell's article. So the article you have on your screen states what we just said, which is the fact that last week the Fed essentially said that it may have to discuss, or it will discuss, the speeding up of its bond buying tapering at the December meeting. And this was all around this fact that they were getting grilled on how high inflation is. So to kind of break things down here, a week after being reappointed as a chairman of the Federal Reserve for a second term, Mr. Jerome Powell was very quick to point out that the Board of Governors of the Fed would be discussing an accelerated tapering to their bond buying program during their December meeting, which happens actually next week. Mr. Powell also got grilled last week in front of the Congress, essentially having to retire the word transitory in front of Congress, as it's no longer appropriate. It's not an appropriate word anymore to describe the recent run or the current run of inflation. And here's an article from Al Jazeera that speaks to just that. He had to essentially retire the word transitory in front of the Congress, or in front of Congress and national television. Why he had to do this, or why he's in such a tight spot, is because the U.S. Consumer Price Index, the biggest barometer for inflation, jumped 0.9% month over month for October. If we annualize this jump, we're talking about 10.8% increase annualized in inflation if we extrapolate the month over month figure. If we compare it to the last October, that prices are up 6.2%. Expectations for the November rate, which comes out this week, the November rate for CPI comes out Friday. We'll discuss it in our What's Ahead section. But that's expected to have a 0.7% month over month gain, which is lower than if we extrapolate last month's October. If we extrapolate this 0.7, we get to 8.4% annualized inflation. Comparing the prices from this November to last November, you get to an annualized difference of 6.7%. And that is the highest number that it's been for a really long time. The worst parts, or just to frame this and why this is so meaningful, is because the Fed's target for long-term inflation is 2%. So right now we're basically trending more than 3 times over the Fed's target goals. And this is exactly what a lot of the questions from Congress were making to Mr. Powell, and why he came under, or he continues to come under, a lot of pressure. In the context of this, or in the background of this, so inflation's soaring, and that's what affects essentially like the everyday person that's buying groceries, etc. But the other piece of this is, unsurprisingly, home prices are continuing to soar, and we've been banging this drum for quite some time on this publication. But in essence, this headline from CNBC is quite misleading, in my humble opinion. The headline states that home price gains have slowed down. While technically correct, it is very misleading. The year-over-year increase in home prices for September was 19.5%. In August, it was 19.8%. So 30 base points on a 20% annualized rate, in practical terms, means that things are just as bad. Prices are just as bad. The S&P Case-Shiller Home Index, if you look at it from in absolute terms, it basically shows that home prices are up almost 46% from their 2006 peak. This means that houses basically on average cost 50% more than what they did in 2006. That's a very meaningful price appreciation for those homes. All of this has resulted in a very real fear that the Fed will have to raise rates to prevent the economy from overheating further. This has fueled a rally in the US dollar, as the real return of the dollar, when you can basically buy dollars and invest them in treasury bonds that have a positive or improving real return, has fueled a rally in the US dollar, which coincidentally has introduced headwinds for commodities and equities. So markets could stay rocky and volatile with thin liquidity for reasons similar to what we described just above. And this could happen very well until the new year. So it's something to keep in mind as we march on to the last trading weeks of the year. Moving over to our analysis of gold, we see that gold finished its third consecutive week of losses last week, finishing down 49 basis points, 0.5% at $1,783 per ounce. There's been some articles around gold from CNBC that state that gold has sort of eased some of its losses as appetite improves and the dollar finds basically some footing. The dollar settles down. But again, while gold is typically seen as a hedge against inflation, and there's been a lot of talk around inflation recently, we see that gold is stuck in a downtrend where it has been basically since August of 2020. So way more than a year, and it's been stuck on this sideways downtrend. There are several reasons for this. One of them is the fact that Bitcoin continues to take mind share and market share away from gold. And this happens because investors see it as a much more exciting hedge for inflation that also has a call option on a new monetary system. So that's been basically hurting gold as it draws demand away from it. The other trend is that as we move into the deceleration phase of economic stimulus, the Fed is looking to let interest rates rise. This creates a better real return for the US dollar. And this has been a big driver in the rally that we've seen in the US dollar. So just to kind of highlight this and put this into context, look at the monster rally that US dollar has had. I mean, if we take it from back in June, it gets it becomes much bigger. But if we look at it just from September 6th, that's 5% increase on the dollar. If you take into consideration that essentially all goods around most supply chains are priced in dollars, this effectively means that anyone transacting in dollars that is not in the US has basically seen their revenues or profits hit by 5% since September, which is a couple months. So again, this dollar rally has not only put pressure on gold, but commodities and equity markets in general. And this trend looks poised to continue until the Fed reverses course. We get more information from the Fed around its plans mid next week with the next FOMC meeting. Moving on to our DeFi analysis, it was another wild week in the world of DeFi with fascinating price action and some very meaningful headlines as well. Price action, just looking at Ethereum, continued to be among the strongest performers, given that there was very positive news for Ethereum this week, which is the fact that the Ethereum micro futures were scheduled to start trading or started trading on the Chicago Mercantile Exchange today, actually. I believe it was last evening or this morning. This is the headline that you have around the micro futures, which is actually this was yesterday. So yeah, the micro futures started trading yesterday in the US. In the Chicago Mercantile Exchange. And again, what's interesting here is that, keep in mind that the Bitcoin micro futures on the Chicago Mercantile Exchange began trading just a few months before the first Bitcoin futures ETF was approved. And so this may be driving some of the excitement around Ethereum, with investors thinking that, once there's Ethereum futures, then there's Ethereum micro futures. The sort of next natural step would be to, for an Ethereum's futures ETF to be filed and potentially approved. So this might be driving a lot of the excitement around Ethereum right now. Separately in the DeFi space, news broke that there was a $120 million hack reported on a protocol called Badger DAO. This happened last week. The headline in front of you is what references the incident. The exploit seems to be the largest in DeFi history so far, and at 120 million, and has sent the value of the Badger token down 21%. Haven't checked in on whether it's still down more or has recovered since, but that's what happened as the news broke. The token basically tanked in value by 20% right away. Lastly, here as a closing thought, we wanted to share what we thought was a very interesting graph. Something that we've been talking about recently here is that the recent rally has favored layer 1 protocol assets like Ethereum, Bitcoin, and Solana, and has disfavored some of the layer 2 tokens like, for example, Compound, Aave, or Uniswap. And just to highlight how meaningful this is, we wanted to essentially put in the chart and compare the price performance from Ethereum to that of Uniswap, Compound, and Aave, so that you can see what we mean. And I think it's pretty evident once you chart them that this depicts just how much Ethereum has outperformed the layer 2 tokens since March. What this shows is that, in our view, they say that markets learn, right? And what this shows is that investors are starting to understand that most project tokens just hold temporary value as their supply gets inflated away and the hype passes. Therefore, investors are not holding on to them as they do layer 1 protocol tokens. In other words, they use these project tokens to claim their rewards or to farm their incentives, the project incentives. Once the incentives are received, they are immediately sold for Bitcoin or Ethereum. And this trend may continue as the markets continue to learn. Moving over to our Bitcoin mining difficulty commentary, the next adjustment is expected in approximately 4 days, and it would bring difficulty up by 2.95%, taking it to 22.99 terahashes, very close to our 25 terahash all-time high. This could mean that the upward trends in the hash rate is poised to resume. As you recall, we had the first negative difficulty adjustment in the last epoch. We shared that news last week. So it's still a bit early to tell if we're going to resume the sort of upwards path, but all signs point to continued healthy growth in the hash rate. Looking at the mempool for a second, we see that transaction costs and speeds remain optimal at the moment. And as always, we wrap up with what's ahead for the week. As we've mentioned here, the Federal Reserve has started its tapering process during its November meeting, and that has set the markets on a rocky path. Investors are trying to balance the fact that the Fed needs to raise rates in the short term to prevent the economy from overheating, with the fact that it cannot hold rates high for too long. The reason it can't raise rates for too long is because it severely impacts the American economy. Everyone's mortgage payment goes up, and every company's cost of debt goes up as well. The Fed is cornered by rising inflation on one end and the markets on the other. If it raises rates, it can fix inflation, but it will bring down the markets. If it maintains its accommodative monetary policy, markets will rise, but inflation will overheat. It is likely that the Fed will need to see more pain in the markets before it makes any decisions to alter the course of its tapering. If inflation continues to stay the course, it may corner the Fed into an accelerated tapering effort, and it may be willing to pay the price of a dip in the markets to tame that inflation. So, as always, we wrap up with a summary of upcoming economic data and earnings reports for the week. This week actually is relatively light on economic data, but the big report that everyone's expecting is Friday's U.S. Consumer Price Index. That's going to come out at 8:30 a.m. Eastern on Friday, and the other big data that comes out on Friday is at 2 p.m. we get the U.S. federal budget. So there, what people will be looking at will be the size of the deficit, because it's most likely going to be a deficit. So that wraps up our show for this week. If you have any comments or questions, I welcome you to throw them down in the comments section, and we'll look to answer your questions or include your suggestions in our next issues. We're going to keep you posted, of course, through right here through the back end, through our social media at Hodl with Ledn. If you enjoyed the show, if you learned something today, we welcome you to share it, like it, and subscribe to our channel and share it to your friends and family. If you don't yet have a Ledn account, I welcome you to check us out, ledn.io, and see how you can start earning up to 9.5% on your USDC and up to 6.25% on your first half of Bitcoin. We also have the best rates for loans if you need liquidity but don't want to sell your Bitcoin. Thank you, everybody. Have a wonderful week, and see you next time.